but it has been, stop watching Fox or CNN or whatever you watch where they feed fake news. Crazy. I won't even emails.
Good afternoon, everyone, and welcome to TRD Talks Live. TRD Talks Live is a new program that we started since the whole pandemic happened to better inform our readers and everyone about what's going on. So we're talking to market leaders, industry leaders, and finding out how they're coping and how they're dealing, and more importantly now, how they're preparing. So today we have Dr. Sam Chandan. And by the way, if you are if you're not a subscriber to the Real Deals digital page, please do subscribe so we can continue to bring you this great programming and the news and the coverage that we provide for you. It's really important that we have all of our viewers' support, and the best way you can support us is by subscribing. And today we are able to bring you this program at free of cost because of our sponsor, Core Scaffolding. Willie Pilku is here. He's going to talk briefly about his company, and then we're going to dive in with Sam Chandan. Willie, please tell us about Core Scaffolding and how great you guys are. And thank you so much for supporting today.
Thank you, Amir. I really appreciate it. I'm looking forward to today's video conference with Dr. Chandan. It's very informative. When I was by the Future City event in the Bahamas, how he spoke already in the middle of February about the pandemic and the effects of the real estate market. So we are Core Scaffold are very happy to sponsor this video conference, and we're looking forward to hear from the both of you. And we want to wish everyone at home that you stay safe and healthy, and God bless everyone.
Thank you so much, Willie. And Corey, wherever you are, thank you too. And I know there's a lot of landlords and developers watching this, and everybody needs scaffolding, okay? In New York City, everybody needs scaffolding. If you're a landlord, if you have a building, so why not use these guys? If it's a sight to see, they do amazing work. And please call Core Scaffolding and use those guys. Now we're going to jump in to Dr. Sam Chandan, who's the Dean of New York NYU Schack Real Estate Institute. He also does work for the federal government, and we're very happy to have him here today. Sam, thank you for joining us. I'm not going to ask you if you're safe and if you're healthy, because if you weren't, you wouldn't be talking to us right now. So we'll jump right into it. Sam, I think the question that everybody wants to know is that after the government prints all of this money, will there be inflation?
Sure. Well, I think under normal circumstances, if it were the case that demand conditions in the economy looked stable, looked something like normal, if it was the case that the labor market was very, very tight in a way that could support what we would think of as a wage price spiral, then certainly a massive infusion of very, very low cost money, into the economy would tend to exert inflationary pressures. We're in a very different situation right now where there's growing slack in the labor market. We have a historic increase in the number of people that are unemployed. We have consumers and businesses that are behaving very, very conservatively in terms of the way that they're spending any discretionary money that they have available to them. And the combination of these factors means that although we're putting a lot of money into the economy, the likelihood of it actually generating that wage price spiral, generating those inflationary pressures is a very limited risk. As compared to an alternative scenario where we were not acting fairly aggressively with monetary policy to support economic activity.
It seems like a short fix, right? It seems like a short fix. And I have to tell you, as a company, I was happy about it. I was happy about the payroll plan, but it does seem like a short fix. It's only supposed to sustain you for 3 months, 2.5, 3 months. What's going to happen after that? I mean, if it doesn't do the fixes that they're hoping for, because it's not like anybody's taking that and they're jumping out there and going to hire people. Like most of the people that we're talking to, they're laying off people. And even after they got the payroll plan, some people have already received it. But do you see it jump-starting anything? Do you see it going beyond the 3 months?
Yeah, so it's an exceptionally timely question because based on conversations that we're having, there are indications that towards the end of today, Wednesday, or sometime tomorrow, the amount allocated to the payroll program will actually be fully exhausted. And so it's
as of today, it will be.
Our understanding is that as of the end of the day today, or sometime tomorrow, that $350 billion allocation will have been exhausted. And we know that there have been difficulties in execution, that many firms have been able to apply for those loans, may have been approved for those loans, but have not yet seen the actual funds transferred into their accounts. What's important to keep in mind, as you mentioned, Amir, is that the program envisions a fairly short disruption to economic activity. And so the amount of the loans that firms are able to take, 2.5 times payroll, are really able to support continued operation, or at least paying those bills and those salaries for roughly 8 weeks. But I think what we see in the economy is that the disruptions that we're experiencing, when we think about sort of the longevity of those disruptions, this really is a relatively short-term intervention to stave off an even more massive increase in job losses than would be the case in its absence. But there really isn't a plan, as part of the efforts that we've seen out of Washington thus far for how it is that we will help to stabilize the labor market 2, 3, 4 months out from this.
And going back to the first question, is it possible to have inflation and have interest rates remain low?
Yeah. So I think if we do see a significant increase in inflation rates, then one of the things we're of course going to want to do is try and understand what's driving those increases. But there would be some pressure on the Federal Reserve, on the FOMC. If we did see sustained higher inflation rates, we would very likely see some pressure on the FOMC to start raising rates. The environment in which they would do that is a highly political one. And so we think all things being equal, their tolerance for inflation would be above the current target. So right now, if the inflation rate heads above 2% in a significant way, we'd expect to see some tightening of monetary policy. If we had an unusual set of circumstances where, with low capacity utilization, with job losses occurring, that for some reason we did actually observe sustained inflation, we think that the Fed would allow for it to rise above that 2% target without actually tightening up on policy as we see it now.
One of our viewers, Mike Mogul, wants to know if there's a chance for deflation.
Sure. So it's a good question. I think that the probability of that, certainly we're modeling a lot of different scenarios, and I think it's important for me to qualify any of the projections and forecasts that we're making by saying that we're collecting new information and data every day that we are then entering into our models, and there's a very wide forecast interval on the models. Part of what is driving that is that the causal driver for everything that we're seeing right now is sort of this exogenous health crisis. And so there are healthcare and health-related inputs into economic models. And we're also making big assumptions about behaviors. So there are a wide range of scenarios that we're modeling when we're thinking about what the next 6 to 12 months might look like. Deflationary risks, we see as a de minimis probability in those models. Are we going to see downward adjustments in the prices of some goods and services? Absolutely. We've seen that with oil already. But do those price adjustments sustain? Do we see continued decline after decline after decline in the prices of some goods and services in a way that would feed into this scenario? That's less likely.
And do you think that if Congress passes another multi-trillion-dollar stimulus bill, it will actually drive up the cost of construction, especially because so many supply chains are going to be interrupted, and there will be, unprecedented public-type projects to get people back to work, like hospitals and schools and things like that. And you speak of these models. Are the models foolproof? Are they prepared for these kinds of this kind of activity and these kinds of changes?
Yeah, so the models are not. I think what's very clear, and what hopefully every economist is being thoughtful about, is that our models and our tools as economists, we're good empiricists. We can take data, feed them into models, look at patterns. Our ability to anticipate changes in behaviors and preferences, we're not quite as good at doing that, and there are very wide forecast intervals. Every recession, every downturn, every shock to the economy is either a little bit different or a lot different. In this one, there are a number of very unique features of this shock to the economy that we're having to account for, and that's impacting the predictive value a lot of the models that we're using.
Mm-hmm. And in terms of construction and the interruption to
So we're less concerned about the possibility of there being so much construction activity that the demand for skilled construction labor, for the inputs to production become the things that are driving much higher prices. What we think is a more likely scenario is that the constraints on the availability of inputs to the construction process, and again realizing that a lot of people are in New York, there are going to be a unique set of circumstances in New York, as there always are. But when we look at this sort of at a national and global level, less concerned about there being runaway activity and sort of a sudden surge in the level of construction activity. The constraints are going to be more likely to be things like difficulties in obtaining construction loans. That is probably going to be sort of a feature of the market. Now, as we've also seen, there are constraints, and there have been constraints throughout this cycle on the availability of skilled labor in the construction industry. That will, we're not going to suddenly see a surge in the number of skilled construction laborers in the United States. On the other side of it, however, there's this larger question that I know a lot of people, certainly the readers of The Real Deal, you and I are talking about every day right now, which is, in the post-pandemic period, to the extent to which, we, are seeing a resumption of economic activity, a gradual resumption of normalcy in the economy and in household behaviors, later on in 2020 and 2021. How has all of this impacted real estate? And what does that mean for the way in which we think about space and the kind of spaces that we feel will be viable to introduce sort of in this new.
It's really interesting that you bring that up, because as for commercial office space, for me is it's right now, I feel like they are the folks that should be the most afraid, because people are realizing that, in the 90s, we moved our call centers out to, India and other countries for a cheaper labor. And that reduced the amount of commercial space people needed. Instead of 3 floors, they needed 2 now. And now people are realizing, well, hold on a second. I don't have to have some of my middle managers in Manhattan, right? Because some of these middle managers can be in Ashford, North Carolina, and I could pay them less. I don't have to pay, the taxes I pay in New York, and I don't have to pay them as much. And they're happy. Their kids go to good schools. They don't have to pay for private schools, and they're near their family and friends, and they don't have to move. And that dynamic not only changes, my thinking is that not only does that change the amount of commercial space people need, but then all of a sudden the residential market changes as a result, because now you don't have those middle managers with 2 kids and 3 kids moving to the city needing 2 bedrooms or 3 bedrooms. They're somewhere else. And, it's just sort of a chain effect that changes real estate, the dynamic of the use of real estate, throughout.
Yeah. So I think one of the phrases I've heard from others and that I've used myself on several occasions is that the future is arriving ahead of schedule. And many of the underlying trends that we've seen in real estate over the course of the cycle, the way that we're using remote work technologies, the way that the retail landscape has been transformed, online shopping for groceries, an area where we had actually seen limited penetration outside of major metropolitan areas up until this point. And some of our resistance to adopting new technologies, to digitizing the way that we work, live, have related to an inherent muscle memory that we all bring with us to the table, that introduces some inertia to our adoption use of these new technologies. We're in the middle of this sort of unexpected and very abrupt and very forced adoption of a lot of these technologies. And I think on the other side of it, folks will say, I had been skeptical of remote work, but maybe there's room for it in the way that I think about sort of how my organization functions. Certainly, we're going to be able to look across almost every sector of the economy and see how this is impactful, not only to the way that we use space, but to the viability and profitability of many businesses. One of the things that is important in thinking about this, of course, is that when we are looking at the current data, I want to emphasize that at some point in the near future, the National Bureau of Economic Research, the Business Cycle Dating Committee, will make some formal announcement about the U.S. economy being in recession. I think if we look at the Beige Book data from earlier today, if we look at the retail sales data from today, and if we look at the raft of economic indicators that we've received, as well as sentiment indicators that give us a good idea of how businesses and consumers, households are responding to anticipated changes and developments in the economy. What I think is fairly clear is that we are now in recession, even though a formal declaration has not been made.
Right. And then in terms of, like continuing to talk about workspace, co-working, right? Like co-working was at 75 square feet per person, where the normal co-working sort of working environment is about 200 square feet per person. Do you think that this is going to change co-working permanently?
So yeah, there are a couple of things here. Sort of, forces that are acting as both headwinds and tailwinds to the way in which we think about using office space. Certainly, remote working, the idea that you can be productive and add value without necessarily being at the office every day, is going to be an important feature of the market. When we talk to folks about the business resumption plans that they're developing at the level of the individual firms right now, we hear a lot of people talking about how when it makes sense for people to go back into their offices, it's not the case that we suddenly flip a switch and everyone goes in on Monday. That it may be the case that certain people go in on Monday, some people go in on Tuesday, but we de-densify. And I think that is going to be something that will persist to varying degrees across businesses, whether we're in New York or in other parts of the country. So the desire to lower density becomes an important feature of this. That has implications for co-working, and not necessarily favorable ones. You talked about how there is a lot less space and higher density in the co-working spaces. That I think is going to be challenging, in terms of the business model. Many co-working spaces are going to be in a position to very quickly adapt to people's desire to have wider hallways, more open spaces, lower levels of density. But ultimately, that does affect the profitability and viability of some of the co-working spaces that are in the market today.
But also for landlords. I mean, if people are asking for hallways not to be 5 feet, for them to be 7 feet, or that people need more space in general, people can't expect to get the same sort of rents, right?
So the challenge of monetizing space when we have lower density is going to be a real one. And that does imply in some cases, lower rents. It does imply, a smaller number of leases. And on the margins, this is going to, again, not just impact office space. This is going to be a feature of, every aspect of the economy. You can imagine a scenario where, for many, many years now, we've been in a world where airline seats seem to have been getting smaller. The number of inches between each row, in the economy cabin has been getting smaller and smaller. There's going to be a move to de-densify. Now, and that may mean for many airlines that the middle seat simply must remain empty for the foreseeable future. And a lot of this is predicated on whether or not we identify sort of in the foreseeable future some kind of vaccine. But a scenario where the middle seat is empty at restaurants, where we have a smaller number of tables, where fire code then requires that the maximum occupancy of a room is lowered. There are some restaurants, there are some flights that simply are not going to be viable under those scenarios.
Do you foresee any sector in real estate that's going to thrive after the pandemic is done, like after the virus is behind us?
Sure. I think that there are going to be what's very clear for all of us. There's been this sudden and very abrupt surge in demand for anything that we can have delivered to us. And so, when we look at the list of
groceries were up 20%.
Online groceries, if we look at the folks who are hiring right now and hiring in very, very large numbers, they're going to be pharmacies, online groceries, the Amazons. Obviously, I think sort of as we return to some degree of normalcy, once bricks and mortar retail starts to reopen, once we feel comfortable, and it will take time, going back out into the world again, that surge in demand for those services will subside somewhat. But long term, I think what we're watching very, very closely, and online grocery sales, I think, is going to be a bellwether for us here. The adoption of online grocery purchases by households in the United States has been very, very limited as compared to many other product types. And again, a lot of that is people's perceptions around product quality, value, price competitiveness, convenience when they're buying their groceries online, as well as just sort of that, again, muscle memory of going to the store to buy your groceries. We are sort of in this environment of forced adoption of this type of service. And I think a lot of people are going to find, it's price competitive, product variety is good. Amazon seems to have no trouble helping me discover new products that I didn't know I needed.
For that, we're talking about So what kind of real estate is going to benefit from that?
I think industrial warehouse distribution, fulfillment centers, many of the things that have seen sustained and gradual improvements over the course of this cycle, are well positioned. And so again, a lot of that industrial space is going to be a beneficiary.
And what kind of real estate do you see that's just not going to survive this?
Yeah, so I think that inevitably there are going to be some stranded assets, and it's not necessarily the case that there are certain types of space or certain product or real estate categories of real estate that become irrelevant or obsolete. There'll always be room for retail and industrial and medical office buildings, but are there going to be some asset classes where there is a more radical rethinking of how we utilize the space? We can look at an example of micro apartments. The idea of density right now is not in favor, and I think that we're going to have to very, very carefully examine what people's behaviors are and how they think about co-location, on the other side of this, to understand how some of these very high density co-location environments are ultimately impacted. But those are the ones that I believe are most at risk.
Hotels have seen a major boom in the last 10, 15 years, especially in the cities. Did you see that sort of reversing?
Yeah, so I think certainly one of the impacts here is that on the other side, we are going to have a larger number of businesses where, whether it's because of the need to contain costs in an environment where revenue and profitability has been seriously impacted, as compared to the great financial crisis, the tools that we have to get a deal done remotely are imperfect, no doubt. But our ability to actually transact business, to develop meaningful relationships, to have conversations like this one, we are in a far better position now with a far more mature set of tools at our disposal today than was the case 15 or 16 years ago. And that next time that a meeting that someone suggests, let's meet, I think there's going to be first a real question about, does it make sense to have this meeting? Perhaps we could have it over Zoom, or do I really need to fly to San Francisco? Right. And at least on the margin, we're going to have some more meetings over Zoom. And that is going to impact, the amount of business travel. It's going to impact business occupancy at hotels around the world, and that is one of the long-lasting impacts of this.
The private equity firms in the last 15, 17 years, they've gotten into real estate heavy. Do you think they have the necessary cash to be able to survive this? The big private equity funds?
Sure. I think when we're looking at folks in the market, whether they be mortgage servicers in the residential space or some of the non-bank financial institutions, I think concerns have naturally been raised by some of those institutions, by policymakers as well, about just how much runway they have in an environment where there's also in some cases either a demand or a request to exercise forbearance, where payments are not being made, where rents are not coming in. And I think over the course of the next couple of months, we're going to see that this is one of the areas where there are where the environment is a little bit more challenging. It's a hotly debated question around things like, for mortgage servicers, what kind of access should they have to lines of credit with various branches of the federal government or with the Federal Reserve. I think over the course of the next couple of weeks, if not the next month or so, we're going to see some more flexibility out of Washington, out of necessity, to support the market.
So do you agree with that? I mean, do you believe you should let capitalism do its thing and let the survivors survive and the people who can't handle it to sort of, recreate themselves? Or
yeah. I think it's going to be important for us to examine and carefully evaluate all of the knock-on effects. If we're to allow an institution that facilitates the market to fall into a condition of distress because on one hand they're being asked to exercise forbearance so that we don't have residential tenant evictions. What is the balance there to then support that institution as well? Because it may ultimately be the case that towing a hard line and acting conservatively in the level of support that we provide to some of these intermediaries in the market, the folks who are bearing the brunt of that could be the residential tenant who is faced with a very limited set of opportunities for where it is that they might go in the midst of a global pandemic.
Right. And how do you I'm curious about the stock market. How do you explain the stock market right now?
Sure. There are a lot of forces at play.
Economists,
yeah.
Economists, what they make sense of that.
There are obviously a lot of forces at play in driving the stock market. Back to your original point about there being a lot of money in the market. That money looks for investment opportunities, and at least some of that money is going to find its way into stocks. And that is so the availability of that money is going to tend to exert some upward pressure on the valuation of the major stock market indices. So that is inevitable. I think what we want to be careful of is to avoid assuming that if the stock market is up 2 or 3% on any given day, and we are experiencing heightened volatility. Folks can look at the VIX measures of the market, but when we see the market go up or down 2 or 3%, it's not necessarily reflecting just market's expectations around corporate profitability. There are a very wide range of forces at play, not least of which is people's interpretations of how different types of policy interventions that are being suggested, recommended, floated in Washington, might ultimately bear fruit in additional capital or support, whether it be monetary or fiscal policy.
In the last 20 years, real estate has seen a real boom, and everybody's gone. It's as an asset class, it's just been doing great. You've seen amazing growth, and in the 90s, that wasn't there. Obviously, you were seeing maybe 2%, 4%, and in the odd years and in the last 20 years, you've seen amazing growth in real estate as an asset class. How do you foresee this pandemic affecting real estate as an asset class as a whole?
Sure. I think that
people are going to pull back, or do you think people are going to see opportunities and sort of dive in?
Yeah. One of the things that many of my colleagues have reminded me of over the course of the last couple of weeks when I've been looking at, jobs, demand for space, the way we think about space, is that on the capital market side of this, there's also, as there has been for a number of years now, a tremendous amount of dry powder sitting on the sidelines. Right. And we had when we were envisioning a scenario where the drivers of recession or the proximate causes of a downturn would be something entirely different from a pandemic. We had thought about that as being a period where a lot of that capital on the sidelines, seeing some downward adjustment in prices, and this is true for residential markets as well, you would suddenly see an opportunity to deploy, a little bit less competition, whether it be competition amongst lenders or investors, let's then put some of this dry powder to work. Very different set of proximate causes for the downturn than I think sort of what the business models had been looking at. That being said, there is money allocated to real estate. It is a tangible asset. I think people are going to be very careful. One of the things that we're looking at here, and this is where I'm not able to make sort of a blanket statement, real estate is fine or money continues to flow into real estate. We're looking closely at indices such as changes in market caps, returns on the major publicly traded REITs, by asset class. And some of the patterns that are emerging, some of the patterns that we're seeing in flash polls and sentiment polls of lenders in the market as well, really are converging on things that I think are going to fit our intuition. And of course, our intuition can be wrong, but what a lot of that data is telling us is that the market is more reserved in its expectations around the long-term performance of regional malls, hotels, office space, seniors housing to a lesser degree. And on the other side of it, we see that the downward adjustment in valuations, the market sentiment has remained relatively more resilient or sanguine when we look at industrial and multifamily assets. In particular, within the multifamily space, as we get a little bit more data, I think we're going to want to separate out and do different analyses. On one hand, relatively high density, Class A urban space on one side of it, and then on the other, sort of garden apartment buildings or garden apartment developments in relatively more suburban communities that are characterized ultimately by a lower level of density.
Mm-hmm. And then, we in the last couple of weeks, we've had a lot of people on here, and they've compared this sort of, to September 11th, to the Great Recession. Obviously, this is different. It's global. How do you see, what are like the key things that are different from this? And how do you, in the ideal world, what do you see that recovery to look like?
Yeah. So I think some of the key things here are that we had a very, very abrupt shock. And you can see over the last 4 or 5 weeks a very rapid deterioration in the performance of the labor market and performance of the economy. The March jobs report that came out a couple of weeks ago, really doesn't offer a good view into the extent of true deterioration in the labor market in March.
It's much worse than what's reported.
Yeah, and there are two reasons we know that. One is that when we're looking at things like some of the high frequency indicators, so we're looking very, very closely at Google word searches on specific terms like unemployment benefits. And we can see very, very clear inflections in that data that are telling us sort of, when did the sense of crisis and the job losses really accelerate. And it was during the month of March, about 2 days after the survey window for the March labor market report. And so we didn't really capture the most significant deterioration during March in that report, which is why when we have April's report come out on May 8th, that is going to capture not only what happened in a good part of April, but it's going to capture the second half of March. And when we couple that with the initial claims data, we have every reason to believe that it is going to show the most serious, significant deterioration in the U.S. labor market for any period for which we have records. That's.
Are you talking about like a year or 2 years or?
Yeah. So I think I think what we'll see in the report that comes out at the beginning of May, covering April, but ultimately capturing the second half of March as well, is the deepest single month of job losses that we've ever experienced. When we look at some of the models here, and again qualifying the models because so many of the inputs to that relate to what happens with the virus. We're talking regularly with folks whose expertise is in epidemiology. We're talking to folks that are driving some of the policies that will help to determine whether or not we have a V-shaped rebound or something that looks much slower than that, as well as folks in countries abroad where the outcomes in China, in India, are going to ultimately be to varying degrees material for the outcomes that we see here as well in the United States. And we do anticipate a more protracted period of recovery in the labor market, different segments and sectors and occupations facing very different sets of outcomes. But this is not a recovery where at the end of 2020 we find ourselves where we were in February. What's important also to keep in mind, though, and this comes back to your point about some of the unique features of this downturn, up until that point where we faced a very abrupt shock, while we can debate around the characterization of what's going on in the economy, certainly there's plenty of room to debate, sort of the characterization in the political environment. The underlying data does tell us that the economy was generally healthy. The labor market was generally tight. We had issues around, disparities in outcomes across folks, of different skill levels. This was not a recovery. This was not sort of a period of growth that everyone experienced equally. But the economy and the labor market overall going into this were quite healthy. And that makes a big difference for us because we're not in a situation where we were facing down this enormous crisis while also having to contend with underlying weakness in the labor market, the economy.
Weren't people afraid of a recession, months before this happened? That was like sort of always on the cusp, I thought.
Sure. I think the last 3-4 years or so, perhaps even longer for the pessimists among us, this idea of what inning are we in, given that, this is now, up until a couple of months ago, this had been the longest expansion in U.S. history. Certainly not the most robust, but the longest. And I think that that naturally raises questions around, well, how long can we go? But was that proximate cause? Was it clear sort of what would that trigger be that would ultimately move the economy from growth to contraction? That proximate cause that would act as a trigger, wasn't very clear. And so, we went into this with on the back of all of our minds, there was this concern around sort of the cyclical nature of the economy. It was not the case that the economy was deteriorating. The other thing I'll mention is that, it's important that the underlying financial system was healthy going into this. It will not remain healthy and stable indefinitely. There will be clearer stresses on the financial system, 2-3 months from now, if we have not seen some at least moderate return to economic activity. Now, I'm not certainly advocating for people suddenly going back to work and abandoning all of the measures that we put in place to contain the spread of the virus. But as an economic reality, there are going to be some occupations, some industries that will have a more difficult time executing on their recovery the longer they are in the current position.
Sam, John from Goldman Sachs wants to ask, in layman terms, how can he explain to his clients what the recovery will look like? So in very plain simples, in an ideal world, what will the recovery look like to you?
Yeah. So I think probably the most important thing to convey to folks is that we're all watching the data very carefully. That our outlook is one that is that we're continuing to refine.
If you had to pick the recovery right now, if you had the power of God in you, what would those steps look like? If you could tell the future, which as economists we count on you to do that. So if you can do that, what would that outlook look like to you ideally?
Okay. Here's a way I can answer the question. We're modeling lots of different scenarios. Our baseline scenario, the one that we think sort of has the sitting at that median and has the greatest likelihood, is one where the rate of spread of the virus slows over the course of the next couple of months, and I think that there's an indication in the data that that infections are beginning to plateau, at least in the United States. Keeping in mind, of course, that in that model also shows that in many other parts of the world. India, South Asia, Sub-Saharan Africa, the challenges, we're still very early, and the capacity of their healthcare systems to actually contain this type of healthcare crisis is much more limited in some countries. In the United States, the model shows that the depth of the recovery, how seriously and significantly we've declined over a very short period of time, is related to self-imposed measures. It's not the case that folks haven't wanted to go out in general, but a lot of the constraints on economic activity that we see right now are because as individuals, we're staying at home. In some cases, we're constrained in being able to engage in economic activity. But we've collectively decided that we're going to be more limited as economic agents during this period. That being said, are we going to have the model also shows that the recovery coming out of this will be one that takes a little bit longer than the very abrupt deterioration we saw. Will we be in a much better position in this baseline scenario in September? Yes. In October, November, will we have returned to some semblance of normalcy? Are a lot of things going to be different? Absolutely. But I think that in that baseline scenario, and again, there are a lot of assumptions being made around what happens in the policy environment, what happens with fiscal stimulus, what happens with the trajectory of the virus itself. We see ourselves in a contraction that is most severe in the second quarter and the beginning of the third quarter of 2020, growth in return to growth by the fourth quarter of this year, and then a reasonably robust growth outlook for 2021, given the depth of the contraction, an outlook for 2021 that may be a little bit stronger than the baseline forecasts were actually going into this. But again, that's because we're coming off of a very deep contraction.
So you think that'll help? David Silas from Fortis is asking, what businesses and what professions do you see being wiped out from this and not coming back?
Yeah, so I think the fact that we're all having to work remotely means a couple of important things. And in our analysis of the labor market, we've gone into some detail to try and distinguish as best we can, again, the qualifier there, but to try and distinguish as best we can, professions where people can work remotely, and this is the key, as being distinct from professions where you can create value remotely. And in the initial phases of this downturn, anyone who can work remotely has moved to working remotely. There's going to be a bit more of a reckoning here.
You don't think there's going to be any, you think now that you see what working remotely is like, you think that's sort of going to remain that way for a lot of people?
I think that out of necessity, there's going to be a period of time where we're going to be working remotely. But I think while we all move, all of us in sort of office occupations and professional occupations move to working remotely very, very quickly, companies over the course of the next several months are going to be forced to evaluate, okay, while many of the jobs and functions within my company can be done remotely, which ones are actually creating value remotely? And that is a critical distinction, because not everyone who's able to work remotely is able to create value remotely. And so while the initial wave of losses has been in all of the obvious places, retail, restaurants, bars, airlines, that next wave of adjustments in the labor market are going to be ones that impact a larger number of professional occupations. In terms of areas that get wiped out in that proverbial sense, there are very few segments or sectors of the economy that we see disappearing altogether. Some of us are still going to go out for dinner. How many of us are going to want to go to a concert with 50,000 other people in the same room? I think it's going to take a while before as individuals we get comfortable with that idea again. But what I think we'll see is that intermediaries are the most at risk here amongst the professional occupations. What we're going to see is that we're discovering now how it is, out of necessity, we're able to leverage a range of technologies that have matured significantly over the last decade to get deals done. And what we're going to find is that there's some intermediaries in the market that careful and thoughtful deployment of technology, new platforms that will emerge, that are emerging today, in response to the crisis, are going to facilitate. Those intermediaries are going to be most at risk when we see how it is that we're able to leverage the technology. In many of the deals we do, that ultimately reduces transaction costs for us as well.
Well, our government is printing a lot of money. Obviously, somebody has to pay for this. If you could sort of design the taxes, coming out of this, how would you go about designing the taxes where, we're not, paying 70% to the government?
Sure. So I think this is a critical question for us, because the discussion that we've had around federal policy interventions thus far is focused on what we must do immediately. And there's been debate amongst the parties around how to refine and implement some of this. But the immediacy of the crisis has required that we move quickly. And that has not left much opportunity in the policy dialogue for discussions around, okay, down the road, how is this impacting us? We're seeing a significant increase in the indebtedness of the United States. And that does mean that in future periods, and we're being cushioned against this right now because the cost of debt to the US government has never been lower. But long term, this is debt that is costly to service. And so for every tax dollar that is collected, some larger all things being equal, some larger share has to go to debt service instead of into supporting infrastructure programs or defense or healthcare. And that's going to be material for us. That introduces inefficiencies into the system. It's probably not going to be something that we experience as an immediate outcome of the steps that are being taken today, because the cost of debt is likely to remain low for some time in that baseline scenario. What I'm far more concerned about when we think about debt and the fiscal position of government is state and local governments in the United States. I think what we see here is that in that first round of life support from the federal government, we should not call it stimulus, in that first round of life support, what we have is a scenario where there are actually very limited transfers to state and local governments. And for those of us here in New York, I think we're aware, the mayor today was citing some initial figures on what the crisis is costing New York City. New York State is looking at serious budgetary shortfalls, as are many other states around the country. Some of the analysis around individual cities that we see has focused on, well, how exposed are they to leisure and tourism? And so, okay, Las Vegas is at risk. I think an absolutely critical piece that we cannot afford to miss in the analysis is that we have markets that face and have faced underlying fiscal inefficiencies. And so we're going to be able to look at certain states around the country that are hampered by serious unfunded or underfunded pension obligations. How are they going to be able to meet those in an environment where tax revenue is seriously impaired? Is it going to be the case that we are in an environment where elected officials are going to lean towards introducing new personal income taxes at the local local level. We know from the experience of many cities and localities around the United States that your ability to tax incomes at the very local level, it's a dicey proposition. So I think there is a real risk, particularly given some of the larger political context of what we see happening with concerns around housing affordability and the deterioration of housing affordability in the United States. There is I think that there should be a real concern in our markets around the possibility that not only will we see more serious fiscal inefficiencies at the state and local level in parts of the country, that some of the nascent recoveries, we've got a market like Detroit that has been in the midst of an extraordinary, and very exciting renaissance, but is not as well equipped as some other cities to tackle this particular, type of fiscal impairment right now. These are all going to be issues for us, and it may be the case that the political environment sees, the weight or the burden of some of the shortfall in revenue being placed on commercial property owners.
Going back to the behavioral way of looking at things behaviorally, do you feel like, for the last couple of decades, people have been saying, by 2040, people are going to, 80% of the population is going to be in the cities. Do you feel like there's going to be sort of an exodus and a sort of a halt on the growth on cities and the dynamics of the cities?
Yeah. If we were to draw inferences from the number of our colleagues who have decamped to Florida or to other parts of the country from New York in recent weeks.
All of a sudden says like, hey, we should get a house in Miami. All of a sudden, they have such a short memory that Brickell was like literally underwater 2 years ago.
Yeah. And I certainly, I do want to convey that I don't mean to make light of any of this. I know all of us on this call today have been impacted, many of us very directly and in very personal ways by the crisis. I think when we're looking at issues around density, one of the overriding things we have to be looking at from a behavioral perspective coming out of this is, do people feel and think differently about density? In particularly an environment where we now have technologies that give us alternatives, right? So if we're less comfortable with high density, we actually have a set of technologies that will facilitate our being productive economic agents at lower levels of density. Has there been a change in the value, the perceived or real value of physical co-location? Those are all going to be real issues for us. I think when we're looking at, as you mentioned, high density office space, micro apartments, there are clearly going to be some segments of the real estate market where questions are raised about density. In terms of the urban environment, there are a lot of headwinds that I think major urban centers are going to have to grapple with. And when we look at sort of the advantage historically has been the density. And so if density is out of favor, that presents a real challenge. Couple that with the fact that the major urban centers are the ones that are relatively less efficient from a fiscal perspective.
And the things that draws people to the cities is jobs, right? And if those jobs, if all of a sudden I could hire somebody to be, again, in North Carolina instead of in Manhattan to do the same job and pay them less, do I need them to be in the city, right? So.
Yeah, the cost, the competition for talent, the cost of living, quality of life, the state of the city's infrastructure, access to good quality schools, all of these have always been issues. The counterbalance for major urban centers has been, the value of co-location. We all, for those of us in New York City, we choose to live here and bear the extraordinarily high tax burden because the returns to each of us as an economic agent from being located in New York City are extraordinarily high. And we can compare that to something like Philadelphia, where there's also a local wage tax, but the agglomeration economies, the returns or the economic benefit of being located in Philadelphia for many years, it was not a good offset. For the cost of being located there, but I think we are going to see challenges facing cities. You've got sort of a series of headwinds. The cap on the state and local tax deductions could not be more troublesome than it is in this environment, because we, as individual consumers, and households, we bear the full weight of these fiscal inefficiencies. The other very, very important thing to keep in mind here then is that it's very clear from some of the data that's emerging over the last couple of weeks that we're seeing differences in the impact, whether it be health outcomes, whether it be labor market outcomes that are are different depending on your level of skill, depending on race and ethnicity, depending on income. While at the higher end of the income spectrum, in many of these professional occupations, we have the luxury of mobility in terms of where and how we do our work. For many, many people, they do not have that flexibility. And these are some of the populations that I think are going to be most seriously and significantly impacted by some of what we're seeing.
Sam, this has been an amazing conversation. For everybody who's tuned in, if you found value in this, please go to The Real Deal and subscribe to our paywall and support the sort of coverage and news and programming that we provide for the market and the industry. Before I go to the last question, I also want to thank again Core Scaffolding, Corey, Willie, thank you guys for sponsoring this and making this available for everybody. And Sam, I want to go to one last question, and then I want to get your final thoughts. Prices, we're talking to a lot of developers, and developers by nature are very optimistic. And to think that we're going to come out of this and prices are going to be, across the board, prices are going to come down. Would you agree with that?
Yeah, I think what we're seeing in the data now, and again, it's very preliminary, is that certainly there's been a downward adjustment in prices. We have higher frequency data coming out of the residential market than we do out of commercial, and there where we have to be again very careful in how we're analyzing the data. Part of what's happened there is that because there's an expectation or a perception of a decline in market clearing prices, a lot of people have pulled their homes from listing. So we've seen a drop in the number of homes available for sale because people don't believe that it's a very good time to be selling a home. Where we do have transactions occurring, they are occurring under conditions of distress. We'll see a little bit of that. Now, obviously, I'm a Real Deal reader as well. I know that there are deals getting done in the market. I know that there are deals getting done in the market. But that bread and butter deal, I think what we'll see is certainly is an adjustment. We will see some downward pressure on prices. There's going to be very, very careful scrutiny, particularly on the debt side and in the lending and the financing to fill out the capital stack. There's going to be a lot of scrutiny of these deals, and underwriting standards are going to take a while, to come off of this position of high risk aversion, and that again also is going to exert some downward pressure on prices. The impact, I think, is going to be very different across different asset classes and across different metropolitan areas and submarkets, which is
going to be down, right? It's not going to be where we left it off. Right?
I think it's clear there's going to be some downward adjustment. The point I would emphasize, though, is that there will be considerable variation, across different parts of the country and across different asset classes, and of course, depending on things like the quality of the tenant roll. So
I want to get your final thoughts, and then we'll call it a day.
Yeah, well, I think like the developers out there, I'm naturally optimistic, and this is, I think, sort of been an extraordinarily challenging time, and will remain an extraordinarily challenging time, for all of us. The data that we're looking at in terms of the trajectory of the virus in the United States, I think a lot of people feel better today than they did a week ago or 2 weeks ago. There are obviously sort of other parts of the world that are still very, very early in this crisis that have a much more limited capacity to manage this crisis in terms of their underlying healthcare infrastructure, the quality of their supply chains to ensure food security, and I want us all to be mindful of that. Real estate has shown itself, the United States has shown itself more than any other country in the world, that we are resilient, we are capable of putting ourselves back to work, and while this particular set of circumstances means that it will take time, and that there will be real differences in outcomes. I'm hopeful for what our next conversation will be like.
Sam, thank you so much for doing this. Thank you for participating, and for everyone else, again, please go and subscribe. And our next TRD Talks Live will be this Friday with Stuart Elliott talking about the tech that's impacting our current situation. Thank you again, Sam, and thank you everyone for tuning in.